Hello. How's everyone doing? Good? Yeah, well, it's great to see everyone here tonight. Thanks for taking time out of your busy schedules to be here with us. But before we start, we do want to go through a few items with you. Most of you should have gotten a folder there at the sign-in table. You'll find a few items in there. You'll find a copy of the presentation along with an invite to next month's event. You'll also find a survey. Now, if you don't mind, please take a few moments after the presentation to fill that survey out. You can drop it off at the sign-in table on your way out. It'd be greatly appreciated. We'll use it to create better content for you guys in the future, so thank you.
Our final event will be November 2nd. It'll be here in Lansing in Frandor at 6 p.m. at Wine and Canvas. It'll be the final opportunity to qualify for the end of the year appreciation event, so be sure to bring a friend, and hopefully we'll see you all there. As a quick reminder, please be sure to silence all cell phones, and thanks for being here.
Well, thank you, Joshua and Jonathan. So I've been looking forward to this event all year, and I'm so excited to introduce our speaker this evening, Denise Appleby. Denise is a nationally recognized IRA expert, author, consultant, and speaker on the tax laws and operational compliance that governs retirement accounts in America, along with employer-sponsored retirement plans. I've worked with Denise probably at this point maybe 20 plus years of my career.
I don't look that old.
But I wonder where the time goes. Goodness gracious. You know, I heard it and now I believe it. But I can assure you she is truly the best of the best. It's a real treat to have Denise here with us this evening. So thanks again for joining us tonight. We hope you have an enjoyable and knowledgeable event for everyone. So without any further ado, let's give a warm welcome to a Southern gal from Georgia to Lansing, Michigan. Denise.
Thank you. Fantastic looking crowd. And for those of you who I met earlier, thank you. Nice conversations. Now, what I'm going to ask you is, as we go along, if you have any questions or comments, just let me know, okay? Because here's what I know. Sometimes I attend events like these and they tell you, why don't you wait until the end? And I write a question down, and by the end of it, I don't remember why I wanted to know that. Right? Yeah. Anybody here love stories? I love a good story. I love a good gossip. And I love when mistakes happen so we can learn from them. But isn't it even better when someone else makes a mistake? Right? So you can learn from other people's mistakes. And one of the things that Joe and I talked about, you know, Joe is so weird, right? Joe will call me on a Saturday and talk to me about tax laws. What do you guys do on Saturdays? Not work, right? My phone ring, it's Joe, and he's saying, Denise, do you hear about that new tax law? Sure, Joe. And we're on the phone for half an hour going through tax law. But here's why this is great. Usually when an advisor comes to me as a new client, it's because they're saying, Denise, my client's IRA blew up and I don't know what to do. Can you help me? That does not happen to Joe, right? Because Joe's like Margot. Hi, Margot. You know, Margot and I was talking earlier this evening, and Margot said, this is such a complex area. I know what I don't know, and I don't try to figure things out. I go to the expert. And some of the stories that we're going to talk about here today is people who are not like Margot, who might read an article in the Wall Street Journal and think, I know enough, I don't need a Joe, right? And then, as we're going to find out, they end up in tax court. But the tax court saying, you should have had a Joe. We don't want that. I started with this case. Sometimes we feel charitable and we want to share our money, right? but you want to be in control where you decide who to give your money to. Would you want to be in a situation where you find out that you have to give the IRS $8.5 million? No, right? That's what happened to this taxpayer, because he didn't work with someone like Joe. He thought he could do everything on his own. And as a result, he moved money from a 401k type account to an IRA, thought that everything was fine. Like, if you think that everything's fine, you're not going to go back and check, right? You know, it's not like when you're leaving the house. Like yesterday, I hopped in my Uber, and about 5 minutes later, I asked him to turn back because I didn't remember if I turned off the stove. That ever happened to you? Yeah. Sometimes that happens to you with your IRAs. But if you think everything's fine, you're not going to go back and check. And that's what happened to this gentleman. He moved money from his 401k to his IRA, and he didn't have someone like Joe, because part of what Joe does is Joe calls me up at the year end and say, Denise, I know there are certain things that I have to do for my clients. And part of that is going back and auditing transactions to make sure that everything is copacetic. And if it's not, then we got to fix it. Because in this particular case, if he was working with someone like Joe, the first time this happened, Joe would have said, listen, I won't try to pronounce his name. Courtier, am I saying it right? I think so. But I can say IRA, though, you know. And so if he was working with someone like Joe, because part of what Joe does is he audits the IRAs, and if there's any mistake, then he fixes it so that you don't have a compound situation like this. Now, he made a mistake in 2004, and he thought everything was fine, so he didn't go back and fix anything. And when this stuff happens, I guarantee you, the IRS is going to find out. That's one of the questions I get a lot. Is the IRS going to know? Well, ask people like this. Because 10 years later, the IRS said, listen, you made a mistake and you didn't fix it. You owe me $8.5 million because of the mistake that you made. And so he took the IRS to court. And he says to the court, you got to tell them they can't charge me $8.5 million. And the tax court said, there's nothing I can do about it. That's the law. You don't want to have that happen to you, right? When you work hard, save your money all your life, only to find out that you have to give the IRS what I would consider a gift just because you made a mistake. So today we're going to be talking about mistakes that people make and how someone like Joe worked with his clients to make sure that you don't make those kind of mistakes with your retirement accounts. And, you know, when I was putting this presentation together, Joe's marketing manager actually says, listen, Denise, I know you're going to go up there and tell your stories, but our crowd wants to know what's changed because they're pretty savvy. And they know a lot of stuff, but they're busy people too. And sometimes as the rule changed, they don't have time to keep abreast of that. So please talk about some of the stuff that has changed so that they know what changes affect their retirement account. That's me. I was going to wear that pink jacket today, and I thought you would think I only have one jacket, so I changed it. So let's quickly go over some of the things that have changed. Did you see this article in the New York Times? A lot of people our age have a lot of money saved. And over the next 10 years, a lot of it's going to be transferred from owners to beneficiaries. And part of what Joe includes in his program is, let's say, I know a lot of you have retirement accounts, right? And I know because you're working with Joe, Joe has put something in place so that in the event your beneficiaries inherit your retirement accounts, they don't have an unintended tax consequence, right? And, you know, it's just a fact of life. Assets are going to be passed from owners to beneficiaries as beneficiaries inherit these accounts. And part of what we want to think about is how do we make sure that those movements do not result in unintended tax consequences? $35 trillion in retirement accounts, 12.5 of that is in IRAs, the rest is in 401k type accounts, which means that eventually they are going to be moved to IRAs. And I'm going to tell you a story how a taxpayer thought he didn't need someone like Joe, so he did it on his own, and what that cost him. Secure Act 1.0. Anybody ever heard that terminology? Man, that was something, because we got up one morning and the rules changed 180, where many taxpayers had measures in place for their beneficiaries to take distributions for a very long period so that they can maximize tax benefits. And here's what I don't do. You know, when you pick up the Wall Street Journal and you see experts giving tips and strategies that nobody else knows about, I don't talk about that in the Wall Street Journal. And trust me, when they call me, I give them the easy stuff, right? And they think they're getting good stuff, but I save the great stuff for Joe. Because when you talk about stuff in the Wall Street Journal, guess who's watching? Congress. And so they hear the experts talking about stretch IRAs and how much it could shield income taxes from the IRS. And Congress said, yeah, hold my beer. And that's why they changed the law. So you want to work with an advisor that doesn't know everything that everybody knows. They're the only one who knows those little tricks, right? And they share that with their client. This is not for the Wall Street Journal, only for Congress to take it away. And that's part of what they took away from us. They said, listen, if you're a beneficiary, this is not your retirement account. Why do you want to stretch it over 50 years for? You have 10 years to take it out, unless you meet certain exceptions. If you're married to the person, if you're disabled or chronically ill, if you're a minor child of the account owner, and if you're not more than 10 years younger than the account owner. So the whole idea is to have it come out as soon as possible. Here's the lesson here. If you inherit retirement accounts from someone, or if you're planning to leave assets to your beneficiary, some information has to be transferred from the account owner to the beneficiary. And someone like Joe, when someone walks into Joe's office and say, Joe, I just inherited a retirement account. Today I was reading an article on a very popular newspaper website. And, you know, actually, on the way over here, one of my colleagues called me. Jonathan was in the car. And you probably heard me sounding very agitated, because this was an article in a very highly reputable newspaper. And it was written by an attorney, right? Must be right, right? No, it has like 10 things wrong with it. And it's things like that that cause problems that have someone paying $8.5 million to the IRS. Because if you see something, and this wasn't the Wall Street Journal, but I'm going to use the Wall Street Journal as an example. If you see something in the Wall Street Journal and it's written by an attorney, you're going to think it's right. Usually, I'm happy to say that the Wall Street Journal is usually right, because they make sure they get the right experts to vet their process. So if someone walks into their office and says, Joe, I just inherited a retirement account, what Joe does, where in my experience, many advisors do not do, is they say, listen, I have a questionnaire. I'm going to ask you 10 questions. And you're probably feeling like you don't want to be bothered with 10 questions right now, right? Because you're thinking about the death of a loved one and you want to transfer those assets to you. But it's such as an important topic, right? And part of what Joe does is he takes that stress from you. So you don't have to worry about choosing the right options as you inherit those assets and transfer it from the decedent account to your account. And Congress is becoming more sympathetic where that is concerned, so they've made some changes, but they still haven't made enough changes, and so people are still making mistakes. And that's where the advisor come in. When you talk to your advisor about anything that has to do with your retirement account, it's not just about investments. Because in my experience, if I open my account statement and it looks like I made some money, I feel good, don't you? Right? And if the market goes down, you don't feel so good, so happy. And a lot of people focus on that. And, you know, I'd say to advisors, listen, that account that you're looking at right now, it's valued at $10 million. But your client's happy. When last did you audit that IRA? Had a recent case where the advisor said, I've never audited an IRA. What are you talking about? I thought he was going to say, you think I'm Joe? Because Joe audits IRAs. And so what we did is we audited the IRA 2 years back, and we found out that even though you were looking at the account statement, it said IRA on the statement, it was no longer an IRA. Because he broke certain rules that meant the $10 million should have been included in income tax like 5 years ago, right? And so we had a situation like that $8.5 million that we talked about, and his account was no longer an IRA. I'll tell you something. I talked about that article where the attorney didn't know the rules. When Secure Act 1.0 was signed into law, everybody knows who that is, right? Jamaica, Usain Bolt? You guys, everybody knows Usain Bolt, right? I'm from Jamaica, you can probably tell. So I had to stick him in there. But when Secure Act 1.0 was signed into law, I'm going to confess something to you. Me and a whole bunch of other experts, like about 10 of us, we were up all night going through Secure Act, and we thought we got everything right. And then a few months after that, the IRS said, no, you got something wrong. And Denise, you too, because you've been telling people that certain rule apply when it doesn't. And so when they sent out the explanation of Secure Act 1.0, we realized that something had changed. And many taxpayers and me wrote to them, and we gave them a piece of our mind. And they said, you know what? We weren't very clear. Yeah. So what they did is, I got to give them this. They said, listen, we weren't very clear. So for people who were supposed to take what is referred to as required minimum distributions from inherited accounts, if they didn't take them, they owed the IRS 50% in excise tax. So you had people who were supposed to take distributions of $20,000. They didn't take it because everybody was telling them that they shouldn't. They didn't have to. And so now they owed the IRS half of that in penalties. And the IRS said, listen, we agree that if Denise didn't get it, then nobody else would. I'm kidding. I'm joking, but they admitted that the language was unclear. And because of that, they said, listen, anybody who didn't take that RMD, that required minimum distribution, if they fell into certain categories, then they automatically waive the 50% excise tax. Now, there's a lot of confusion surrounding this. And you may have heard advisors talking about this and experts explaining it. But when Joe and I met about this on a Saturday when he called me asking me if I saw this, we dug into the rules. And we looked at a bunch of articles that were online and realized that a lot of people who were supposed to be experts were getting it wrong. And Joe said to me, Denise, that's one of the reasons why I encourage my clients. It doesn't matter how much they think they know. They should come to me before they make any decision when it comes to retirement accounts, whether it's an IRA or a 401k. Another rule change, Secure Act 2.0. I'll tell you a story. If you take money out of your retirement account before you reach age 59 and a half, you're subject to a 10% additional tax. And one of my clients called me because his client was 45, and unfortunately, her doctor told her she was about to die, right? Pretty young. And she needed money out of her IRA to pay her medical bills. And if she took that money, usually when someone takes their money before 59 and a half, it's because they need it, right? And imagine you have to pay an additional 10% penalty on that. And luckily, these are conversations that I have with people like Joe. So I was able to say to him, hang on a second. She doesn't meet any of the regular exceptions to the penalty, but there's a new provision under Secure Act 2.0. You see why it's important to keep on top of these things, right? Because they change like that. And then you can find solution for clients who think, in her case, she wanted to take out $200,000. She would owe income taxes on it. and she would owe the 10% early distribution penalty. She spoke to her attorney, she spoke to her CPA, and they all told her that she was going to pay the 10% penalty. But when she called me, because this is something that I look at as soon as they come out, we realized that there was a provision that says if your doctor tells you that you're going to die in 84 months, then you qualify for an exception. And so when the advisor called me, he said, Denise, but she's undergoing some experimental treatment. What if she lives? That's perfectly fine because the regulations say if you're reasonably expected to die, then you get the exception. So if you live, great. You know, and whatever you believe in, let's root for her and hope she lives, right? So if she lives, she get an exception to the 10% early distribution penalty. Anybody here with grandkids? I just had a grandson. His name's Noah. And so we're setting up a 529 plan for Noah. Now, here's part of the issue with 529 plans. Sometimes you fund it, and when the kids finish college, they have money left over, right? And if you take that out, you're going to owe income taxes on the earnings and the 10% penalty. And Secure Act 2.0 is another change where they said, listen, we understand that, so we're going to allow these beneficiaries to move up to $35,000 from a 529 plan to a Roth IRA. So if you have grandkids or relatives with 529 plans, have them talk to Joe, because this gets into the weeds, and we would be here until tomorrow morning if I explain all the details. Now, part of what I want for you, right? I don't expect you to remember everything that I talk about tonight. I don't expect you to understand much of it. But, you know, when you sit and Josh, when you're smoking your goat, he has goats. He does. And someone brings up 529, the light bulb should go off, right? So what we're talking about here is light bulbs, not knowledge. No one expects you to be an expert. But something should go off where you say, I have to talk to Joe to see how this rule works and to make sure I don't make any mistake. Now, the handout that you have, I cover a lot of material. Some of it you might hear about tonight. Some of it you might not. And as you go through it over the weekend, because you're looking for something fun and exciting to do, and that's the fun and exciting thing to do, then you call Joe. You can probably call him on a Saturday too. I don't know. Joe? he calls me on a Saturday, so I figure you can probably call him on a Saturday. I'm supposed to talk about required minimum distributions. Those usually begin at age 73. But, you know, I don't see anyone here who's that age yet. So I'll just barely touch on it, right? If you're at least age 73, it used to be age 72. And they changed the rules again. Now, once upon a time, we used to say if you're 70 and a half, you got to start, then it goes to age 72, and now they have like an age schedule. So now you got to call Joe and say, Joe, when do I start? And guess what? As we're going through the regulations about this, we realize that there is another mistake. So people are calling me, asking me, why is it that someone who was born in 1959 falls into two categories? And so we wrote the IRS, and the IRS says, yeah, we've been hearing about it, we're going to fix it, so tell your clients it's all good. We're working on it. Everybody makes a mistake, right? So we got to know when to start taking RMDs, because if we miss the deadline, the excise tax has been reduced from 50% to 25% now, and in some cases, it can even go as low as 10%. But we got to know when to start, because if we don't start by the deadline, then we're going to owe the IRS. Joe called me some months ago because he knew someone, a new client who was coming in, and they were very worried because they found out that they didn't take their RMD when they were supposed to, and now they owe the penalty. And their CPA is telling them, you got to pay the IRS a 25% excise tax. But we knew that there's a provision that says if you miss that deadline and it's not your fault, then the IRS will waive the penalty. All you got to do, all the CPA had to do was file a special form called 5329. So sometimes when you see a mistake has been made, don't panic. Don't panic unless Joe says there's nothing that can be done. Because in a lot of cases, there is a solution. Ask Joe when you need to begin. And ask him, because if this is your first year that you got to take your RMD, you can actually wait until next year to take it as long as you take it by April 1. But one of the things that Joe and I talked about is, let's say your RMD for this year is 20,000. And next year it's 25,000. Should you take the 20,000 this year, or should you wait to take it until next year? And we know that that's a conversation where we bring in the accountant, because the accountant's gonna look at the numbers and say, if I take it this year versus next year, you know, next year you're gonna retire, maybe it's a good year because you're not gonna have your salary coming in. So there's a lot of moving parts to it, right? You know, I like to tell clients, when they ask me a question about an IRA or a 401k, it's never, ever a yes or no. It always starts with it depends, right? Because there's so many moving parts that could change the answer to a question, including who are we talking about? So all of your tax-deferred retirement accounts, except for Roth IRAs, are subject to required minimum distributions, which means you got to start once you reach that RMD age, RMD required minimum distributions, except for Roth IRAs. Now, part of what we've been saying to the IRS all these years is, if Roth IRAs are not subject to RMDs, why is Roth 401k subject to RMDs? Because you know why they put the RMD in place? Because earnings grow tax deferred and they never get the income tax that's due unless you take it out. And so they put in this rule that says, once you reach age 72, we want our money. And if you don't take it out and give us our income tax, we're gonna fine you, right? So it didn't make sense for a Roth 401k, and eventually they changed it on the Secure Act 2.0. So if anyone has Roth 401ks, Roth 403bs, governmental, Roth 457bs, come next year, you no longer have required minimum distributions for those accounts. The calculation for required minimum distributions can get complicated. And so Joe would say to me, Denise, who's responsible for calculating this? And I'd say, Joe, it's the IRA custodian when it comes onto an IRA. It's the plan administrator when it comes onto a 401k. For inherited account, you guys are on your own. The IRS said to your financial institution, do not even begin to calculate RMDs for their inherited accounts. That's not your business. It's too complicated. And Joe says, I'm not leaving my clients in the lurch. Because if it's too complicated for the IRA custodian, if it's too complicated for a Schwab, if it's too complicated for a Fidelity, what is Bruce supposed to do? You know, Bruce? Right? That's not right. And so Joe says, I am Superman for my clients, and I should have worn my Superman t-shirt, but you know, I'll fix it for my clients. And that's the kind of thing that you get from Joe, the extended service that you don't get from your financial institution. Because trust me when I tell you, 20 years ago when you opened your account with the financial institution and they wanted your money and they would bend over backwards, they're not doing that anymore. They're not filling out forms for you. They're not helping you to process your transactions based on what you want. They hear stuff you say and they don't ask you probing questions, right? And you don't know. You're probably like me when I see an insurance contract. What is that? What does that mean? And so I just sign it, right? And Joe says, don't do that. I'll be the front man for you. I'll look at that paperwork. I'll make sure everything's right before you sign on the dotted line. And that's the kind of IRA advocate that you want. Joe is fantastic, man. You know, I get upset when mistakes are made with retirement accounts And listen to me, I have called the CEO of some financial institutions and I've written them letters because I'm so upset when they allow these mistakes to be made. And so I appreciate someone like Joe because Joe acts as a gatekeeper for his clients. And the mistakes that I see happening with other people's accounts, I don't see them happening with Joe. And Joe, thank you, because you make my job easier. Now, one of the mistakes that is often made is if someone inherits a retirement account, if the account owner was supposed to take that RMD that I talked about and didn't, then the beneficiary has to take it. And a lot of people forget that, right? Here's something that you should do. If you have a retirement account, right, you might not want your beneficiary to know that they're the beneficiary, right? You have a niece and a nephew and you like one more than the other. You don't want them to know because if they know, they're nice to you. You know, you're saying, are they nice to me because they're my beneficiary? Or do they really love me? And so you don't have to let them know. You can let them know, but you don't have to. Regardless of what steps you take, you gotta put something in place so that when your beneficiaries inherit their retirement account, they know what to do. Because if something happens to you, they're consumed with grief. And they're not worrying about that until it's too late, and then we have a problem, right? So you want someone like Joe who's gonna help walk them through the process step by step so that they don't make any mistakes. And one of them is RMD for the year of death. Now here's what Congress said. Under the old rules, if someone died and was supposed to take an RMD, the beneficiary had to take it by the end of the year, or they would owe the IRS the excise tax. Come on. If someone I love died, I don't have time to be thinking about that, right? And so they agreed and they said, listen, we're changing the rules and we're giving them until next year to get it done. As long as they get it done by their tax filing due date plus extension, then everything's fine. Retirement accounts will move, whether it's from one financial institution to another or from one person to another, from the account owner to the beneficiary. And this is where I find that most of the mistakes are made. As people move retirement accounts, whether from one financial institution or from their 401k to their IRA. When I looked at the stats, rollovers were one of the most common transactions, right? If you retire and you have a 401k or a 403b, you probably don't want to leave it behind, right? You're going to move it to your IRA. You don't want to leave it. Next thing you know, they merge and you can't find company ABC because now they changed their name 10 times, right? And so you want to move it to an IRA where you keep track of that and you're not depending on some employer to tell you that they had a merger or acquisition. And that reminds me, I need to go home and check because my custodian just had a merger. So I need to make sure everything's right. It's funny the things that come to you at 3 a.m. or while you're doing a presentation, right? Somebody send me an email so I can make sure I do that when I get home. Now, you might think, I'm with company A, I want to move to company B. And it's your right to do it. And you think it's very easy, right? But as I said, they're not helping you anymore. And if you don't move it right, you could end up with a taxable transaction that you did not intend to be taxable. Because one of the reasons why you roll over money is to maintain tax deferred status. You wanted to keep that same IRA flavor so you don't pay income taxes on it until you're ready. But if you make a mistake, you could lose the tax deferred status. You could owe the IRS $8.5 million, as we talked about, right? You could owe a 10% early distribution penalty. If you're under age 59 and a half, you could pay income taxes twice on the amount. So when you're ready to move retirement assets, you want to make sure that you work with someone who understands the rules so they don't make a mistake. Usually, when I get a call from a financial advisor who's not used to me, anyone familiar with the term rollover? Yeah, right? And transfer, right? So I'll get a call from a financial advisor and he'd say, Denise, I'm doing so great. You know, I have a new prospect who wants to roll over their IRA to me, and I'll say, do you mean transfer? And the advisor will say, well, yeah, you know what I mean, right? So let's just move on. I said, no, because, you know, it's like a memory muscle. When you're used to doing something, you always do something. You know, it's like that time I drove to work, because I used to take public transportation, and that one day I drove to work, and I was so happy that I drove to work because I didn't have to take public transportation. And that evening when I got home and I showered and I went to bed, I said, Jesus, I drove to work today. And I took the public transportation home. Can you believe that? It's that thing that happens when you're used to doing things over and over. And so if you're saying roll over when you mean transfer, and transfer when you mean roll over, you're going to call the financial institution and tell them that you want to roll over. Or you're going to say roll over to the client. And the client won't know. And so if you ask a financial institution for a rollover, they're going to give you a rollover. I'm not saying a rollover is a bad thing, but I'm saying with rollovers, bad things can happen that will not happen with a transfer. Right? And so when you talk to your advisor, if they don't know the difference between a rollover and a transfer, and when one should be done, you smile. And you say thank you, and you never go back. One of the reasons why I like a transfer is because you can do it 10 times a day if you want to. There's no limit, there's no deadline, whereas with a rollover, there are certain limitations when you're moving rollovers from IRAs to another. Real life case, right? You know, I felt bad for this client because he, pretty young, in his 60s, and when his attorney called me, his attorney said, Denise, my client made a mistake with his 401k. He's been working all his life. He saved about $1 million and he felt good. You know, he had a house paid for, had $1 million. So he's retiring now. And he's just going to do little odd jobs to, you know, get some extra spending money. So he called a financial institution and he said to the associate, I want to roll over my 401k to my traditional IRA. And they're usually very pleasant. When you call them, they're pretty nice, right? Don't get fooled by that. So once upon a time, the associate, 20 years ago, the associate would have said, go to your new financial institution, your IRA custodian. Tell them to set up your IRA and tell them to send me proof that you have an IRA. I want proof that it's the right type of IRA. And I want confirmation from them that they're going to take it and it's not going to result in a taxable transaction. That's what used to happen. You know what's happening now? They said, okay, here's your check. Go take it to them. That's what I'm talking about when I say they're not helpful anymore. And so you need to work with that financial advisor who knows IRAs. Now, everything sounds good so far, right? Now, on the check, it says TR, IRA. TR stands for traditional, because it's either traditional or Roth. So he takes it to them, the new financial institution, and he said, you know, I've seen your ad on TV, and it makes me feel like I can trust you with my $1 million. And they smiled, and they were very pleasant, and they said, of course, you're at the right place. What's your social? Because he didn't know his account number. So he gives them a social security number, because taxpayers don't know the difference, right? They don't understand, so they need someone like that to help them. And all she did was pull up an account number by social security number, and says to him, write this account number on the back and endorse it, something that should not have happened because it was made payable to them. So come January, his accountant says, you have a Roth conversion. You know what that means? Instead of it being a rollover, non-taxable, it turned out to be a taxable transaction. He owed the IRS almost $500,000 because of their mistake. And they wouldn't fix it. They still have not fixed it, right? So you know what this man had to do? He had to take money out of his house to pay that tax bill. Is that right? No. But unfortunately, because there's so much information on the internet, there are a lot of individuals who feel like they can do it on their own and they don't need a professional. You know, it's like needing heart surgery and reading a manual and thinking you can do it. It seems clear, but it's clear as mud sometimes. So you got to work with someone who would have, you know, part of what Joe does is when someone wants to do a rollover, and you know, his team can tell you, and I tell them, Joe and I talk often, and if he needs to call me 10 times a day, he will, right? Part of what Joe does is, if Joe had gotten that check, Joe would have made sure that the right type of account was set up. But not only that, Joe gets on the phone with the old financial institution and say, I want you to prove to me that this is coming from an account that can be rolled over. And sometimes I hear them in the background, you know, because how it works at those firms, right? They get rewarded for the amount of calls that they take. So they don't want to have Joe on the call. Because Joe is saying, hang on a second, this is my client's money. And we got to make sure we do it right. Did this money having after-tax assets? Did this account having employer securities? Is this a Roth account? And sometimes if Joe hadn't done that, then mistakes like that would have been made. Right? Any questions? Comments? Anything you want to know? You learning anything? Yeah. You scared a little bit? Yeah. It's not my intention to scare you, but it's what we see in the business, and so we want you to be aware of it, so that you don't make those mistakes. And when you go home, you know, I have a cousin. When she reads bedtime stories to the little kids, she reads the scary ones. She's so evil. And so, you know, they can't sleep. But unfortunately, as you get together with family this weekend, you're going to have to tell them some of these scary stories, because these are stories that are going to help them, right? When you take money out of your account and you use it for a little bit, if you want to avoid income taxes, you got to put it back within 60 days. In some cases, there's a restriction on how often you can do that. When I get a call from Joe and says, Denise, I have a new client, or someone who wants to be a new client, and they're telling me they have this check in their hand, and they missed the 60-day deadline, which means they're going to owe income taxes on it. What can we do about that? And part of what we do is we look at the tax code to see if there are any exceptions that would allow clients to do that. Who was telling me about the $10,000 fee? Where is it, Bill? It's not you? Someone was saying, when the IRS tries to fix this, they charge you $10,000. It's $12,500 now, right? When you make a mistake. Was you? Yes. Remind me your name, please. Scott. That's what Joe was telling me. We have a lot of brilliant people in the audience, and I'm. Yeah, I like that. So, you know, part of what Joe looks for is there any exception that would allow you to put the money in and not pay income taxes? Did they give the money to the financial institution, someone went on vacation, forgot it, and stuck it in a drawer? So they get a year instead of 60 days. Believe it or not, the IRS has a process called a private letter ruling, where you got to pay them the $12,500, and they keep the money whether or not they approve it, right? Yeah. But believe it or not, they said, listen, there are a lot of reasons that we approve this for. Like, was there a death in the family? Was someone incarcerated? Was there a natural disaster? Let's tell them to keep their money and work it out on their own. Can you believe that? Yeah, so they're saying no to a lot of $12,500. So that's part of what Joe's process is. He checks to see if you qualify for a waiver, so you can get to roll over those amounts and have it not included in income. I this case just gets to me every time because if the client, sorry, Mr. Tech, he doesn't want me touching my ear. So if they don't qualify for the first two that I talked about, the next process is, can they go to the IRS and get a waiver? And before you tell a client to go to the IRS, remember, they're keeping the $12,500, right? Is the IRS likely to waive the 60-day deadline and tell them go ahead and put it in? Not necessarily. Here is a case where this person is selling their house, right? And they see another home that they like. You know how it is when you see a home that you love, right? You want to get it before anybody else does. But he doesn't have the money. And the house that he owns hasn't been sold yet. And his real estate agent said to him, why don't you take it out of your IRA? And then when you sell the first home, you can put it back. Oh, man. They say man plan and God something? God laughs. Yes. And that's what happened in this case. Because that house did not sell by the 60-day deadline. And so he goes to the IRS and he says, here's my $12,500. Can you cut me some slack and allow me to put it back in? And the IRS says, why? He said, my real estate agent told me to do it. My financial advisor didn't tell me not to do it. And the IRS says, I can't help you because you had the money tied up in real estate. And why are you talking to your real estate agent about this thing? They sell houses. They don't know anything about this. And so, he had to include that amount in income tax, right? Why is he talking to his real estate agent about something like that? I tell you, part of what we do is we if you don't believe us, we include the IRS private letter ruling so you can read it for yourself and see exactly what happened in this case. If you take money from an IRA, put it back in an IRA, you can do that only once during a 12-month period. If you break that rule, this is not one of those that you can go to the IRS and say, please help me. They can't. The tax law says the IRS has no business waiving that requirement. And so before you move money from one IRA to another, you want to make, yes, sir. Absolutely.
Can you do partial? So, for example, the person takes $100,000 out and intends to put it all back and only puts $50,000 within the time frame. Is that lower consequence to $50,000?
That is such a great question. So he's saying when you take a distribution from, say, an IRA, right? Let's say you take 100,000. And you know, if you put back 100,000, that means it's non-taxable, assuming none of the rules are broken. What if you only have 50,000 to put back? Can you put back only 50? What do you think? Yeah, you can put back only 50. You don't have to put back the entire 100. And what happens then? The 50 that you put back would be excluded from income. That's an excellent question. Thank you for that. Now, this case, man, was a mistake made by a tax attorney. We know tax attorneys are smart people, right? And this is a tax law area. He made a mistake. Do I see a hand over there? Yes, sir.
Is it a 12-month period or a calendar year?
Excellent question. We actually do get that a lot, right, Joe? It's a 12-month period. So the 12-month period starts when you get the check. So if you get the check today, we're starting counting 12 months from today. And you're locked up for the next 12 months. What is your name, sir?
Bruce.
So Bruce, this tax attorney learned a hard lesson because he had 2 IRAs. And so he thought he could do this twice. But I'm not blaming him. 50% I'm blaming him, 50% I'm not. Why? Because the IRS has some publications on their website. Publication 590 is one of them, where the IRS says, we're the smartest people in the room, and we're going to break down the tax law for you. Here, consumer, this is in plain English. And so he looks at the IRS publication. It told him he could do it. And so he did it. And then someone else at the IRS who's doing his tax return said, you can't do this. And so they included one of those rollovers in his income. And he challenged the IRS. He took them to court and he lost. But because the tax court said, you can do only one IRA to IRA rollover during a 12-month period. And he appealed to the tax court and he said, listen, you can't blame me because I was looking in IRS publication 590 and it said I could do it. And you know what the tax court said? You use IRS publications at your own peril. I mean, can you believe that? So, you know, when the IRS publishes the IRA publications, update them in the new year, part of what I like to do is, you know, go through it and stuff. And Joe knows. If Joe gives you information and says publication 590 says you could do it, Joe has already checked the tax code to make sure that publication 590 is right. Yes, sir. Excellent question. So he's saying if I have 2 IRAs and I took distribution.
One's with Joe and I really like that, and one's with someone else and I don't, so when I go to pay it back, I want to get it off.
Yeah. So he likes you, Joe, so he's going to take the money from you, from the other firm, and put it with you. When he has another IRA, can he do the same thing, right? You can only roll over one of those. Because once you take a distribution and roll it over, you're locked in for the next 12 months. And part of what came out in this tax court case is all of your traditional IRAs, SEP IRAs, simple IRAs, they lump them and treat them as one. So you take a distribution from one and roll it over, you're locked in for the next 12 months, which is why when you want to move it to from that financial institution to Joe, you're not going to use a rollover. You're going to go to Joe and say, Joe, I like you. I hear you've been doing great things for clients. I want to move my IRA to you. Can you help me? You want to go to Joe that you're moving it to, right? And what Joe is going to do is going to set up your IRA, and then he's going to submit it through a system called the ACAT system. You don't need to remember all that. Just call Joe. And Joe is going to submit for a transfer to the ACAT system. And the transfer, it's not reported to the IRS, but a rollover is. It's not subject to the 60-day deadline, but a rollover is. And it's not subject to the 1 per year rollover rule, but a rollover is. So isn't that transfer better? Yeah. Right? Real life case, man. I tell you, I get these calls from people. So this attorney calls me and he says, Denise, my client is a serial investor. He doesn't have cash outside of his IRA. And he has done 16 IRA to IRA rollover in the past 12 months. You can only do one. And so he says, Denise, I have a check in my hand. It was like for $1 million point something. What am I supposed to do? Right? Because right now he's thinking, there's nothing that can be done, but I know you have always said, don't give up until you check. And so the good thing about this client is his serial investing thing was an actual business. And he had a 401k for that business. So I told him, take that check and put it in a 401k. Why? Because that 1 per year rule that I talked about, 1 per 12-month period, does not apply if a 401k is involved, right? So we found a solution for him. What if this person didn't have a 401k? Then you could deposit that amount to a Roth IRA because Roth conversions are not subject to that 1 per 12-month rule. It's going to be taxable if you put it in a Roth, as we found out about that $1 million client, right? But it's the lesser of two evils, because if you don't put it in the Roth, you're going to earn income tax on any subsequent earnings. Whereas if you put it in the Roth, then the golden ticket item happens where earnings eventually becomes tax-free. Here's another one. When you move money from your 401k to your IRA, your employer, plan administrator, must tell you if you can move all of it. And sometimes they make mistakes, right? I'll bet you $1 that come January, I'm gonna get a call from someone who says, Denise, my rollover from my 401k includes my RMD. Because part of what Joe does, when Joe is working with clients who's moving their 401k to the IRA, Joe asks them, are you supposed to take an RMD? And if you are, have you taken the RMD already? So something like this won't happen, where this is a nice RMD amount, right? Means this is a nice size account, right? Good problem to have, but you want to avoid it. So he rolled over his 401k to his IRA. Then he got a letter from the plan administrator that says, we forgot to tell you that you should have taken your RMD before the rollover. So now you have what is referred to as an ineligible rollover that creates an excess contribution. Now, if he didn't fix this, he would owe the IRS a 6% excise tax for every year it remained in the account. 6% is $700,000, right? But we were able to fix it. But before they called me, they called the financial institution, that's the IRA custodian, and said, how do I fix this? And the financial institution, they actually put this in writing, which surprised me, because usually they say it on the phone so they can say, oh, you misunderstood. But when it's in writing in black and white, they can't claim that. And they actually told him, you don't need to do anything, just take it out when you're ready. You know, and he got that tingling sense that says, this doesn't sound right. Because the right thing to do was to remove it by a process called a return of excess. And that prevents double taxation. You know that, right? Yeah. And if he had listened to them, he would have paid income taxes on it twice, because the 401k is reporting it to the IRS as taxable. And if he had listened to them, they would have reported it as taxable. Now you're working with the plan administrator, you're working with the highly reputable financial institution, and you think they're right, right? But we know now enough that we're going to check everything, right? Even if it sounds logical. Because trust me, when it comes down to IRAs, nothing is logical, right? I like to call them big box custodian. You know? Yes?
So when you say return of excess, would that have been put back into the 401k?
Excellent question. No, it wouldn't. Did everyone hear that?
No.
Okay, so this $700,000 that was rolled over to the IRA and created a return of excess, it had to come out. And she's asking, do you send it back to the 401k? No, you don't, because they are already reporting it on a form called a 1099-R as taxable income to you. And so with the return of excess, so glad you asked that question, because you don't just go to the IRA custodian and say, give me the $700. You have to say, give me the $700 as a return of excess. And the reason for that is when they process it as a return of excess, it's processed as non-taxable. It has to include any earnings or reduced by any loss. And if there are any earnings, that's the only amount that's taxable. But if you do it as a regular distribution, it's taxable. So it has to be done as a return of excess and must be done by your tax filing due date plus extension. Because if you miss that deadline, then you're going to owe the IRS a 6% excise tax for every year it stays in there. Right.
But that was did you say that was a direct transfer?
It was a direct rollover, right?
Okay.
And so you would think that the plan administrator, because they're usually knowledgeable plan administrators, you would think that they would have known. But they make this mistake a lot. And usually, as in this case, he rolled it over in January, and by the end of February, he got this letter that's saying, oops, we made a mistake because this rollover includes your RMD of $700,000. Yeah. You can't roll over an RMD. If you're supposed to take an RMD, you got to take it before you roll over. It's a weird rule, right? Because you could think, oh, leave it there and take it later. No. You got to take it first and then roll it over.
Okay, so the solution to their problem, the 700,000, is a distribution to the owner of the IRA?
It's a distribution, but it's a special type of distribution called a return of excess. Yeah. So you're right, because we have different types of distributions. And so distribution would be the umbrella term here. Which one is the subcategory that we need to apply? In this case, it would be a return of excess, right? So, you know, when you fill out that form and ask for a distribution, there has to be a box where you check to say return of excess, right? And if they're doing it on the phone, because more and more people, more and more financial institutions are taking instructions over the phone, which makes me nervous, right? So if you're doing that, you know, you talk to Joe and you say, Joe, what should I tell them? And you write down some bullet points that you're going to tell them. And when they try to force you into a corner to hurry up and get you off the phone so that come the end of the quarter, they get a good review that they took a lot of calls, you say, no, I have this list from Joe. And you got to confirm that this is this, you got to confirm that is that. And you write down the time when you talk to them, the date and the time down to the second, because they record those calls, right? And when they do the wrong thing, you call them up and you say, not only did I tell you that it was a return of excess, I told you so at 3:45 p.m. and 15 seconds. And this is the number I call, and this is the person that I spoke with. Yeah, we got to be diligent. This is one of the things that we need to think about as we move money from IRAs to 401ks, the 10% additional tax. And a lot of taxpayers, here's the problem. If you're under age 59 and a half and you take money out, you're going to owe the IRS a 10% additional tax or early distribution penalty unless you qualify for an exception. And they don't make it easy because some exceptions apply to 401k type accounts, some apply to IRAs, and some apply to both. And the question becomes, which applies to which? Now you go to Joe pulls out his cheat sheet and he says, what type of account is this? Because we want to know what's going to happen. Now, this is a taxpayer who doesn't go to Joe. He says, I know enough. And he qualified for an exception, right? And so he feels good. He qualifies for what was referred to as the age 55 exception, which says if you separate from service in the year you reach age 55 or later, any distribution that you take after you separate from service is exempt from the 10% penalty. Good so far, right? Here's what he did. He rolled over the money to his IRA, direct rollover, and then he took the distribution from the IRA. And when you take money from your IRA or your 401k, the IRA custodian is going to snitch to the IRS, right? And they do that by filling out a Form 1099-R, and they said to the IRS, they put a code in box 7 and says, you see this man? He owes you 10%. And so he doesn't pay it because he's thinking, I don't owe it, I qualify for the age 55 exception. And so the IRS says, where's my 10%? He says, I don't owe you. And he took the IRS to court and he lost because he qualified for it at one point, but he lost that qualification because he rolled it to an IRA and then took it from an IRA, and the IRA does not qualify for that. One of the things that Joe does when he's rolling over money from employer plans like a 401k is check to see if there are any employer securities in the account. And the reason for that is usually when you take money out of your retirement account, it's taxed as ordinary income, right? But sometimes if you have employer securities, you get a special tax treatment where it's taxed at a lower rate. And so Joe always checks the 401k statements to see if you have employer securities and talk about whether or not it makes sense to roll it over or use this strategy, and what are the special rules that apply if you're going to be using this strategy. One of the biggest debates right now is, should you do a Roth conversion? You've heard that, right? Some people think everybody should do it. It's not true. There is no tax strategy that applies to everyone. You gotta work with your CPA to do a Roth versus traditional to determine if it's right for you. But there are a few instances where you absolutely should do it, and that's if you have after-tax assets in your 401k, for instance. You move that to your Roth IRA, and it's a tax-free conversion. Don't want to put that in your traditional IRA. It creates a mess over there and a lot of tracking that a lot of people lose out on and end up paying double taxation. So what Joe does is he checks your statement, see if you have after-tax assets, and work with you to make sure that goes into your Roth IRA so you get a tax-free Roth conversion. Right, Joe? Yes. How do you move inherited accounts? Carefully. Because these are the ones where, if you make mistakes with it, it's over. So you got to be extra careful. You got to be even more careful than you are with your own accounts. With the new rules now, most people have 10 years over which to take their account, and we're not happy with that, right? But if you move it the wrong way, it ends up being 1 year instead of 10. So now you have an even bigger problem. And those few exceptions that can take it over their lifetime, they could end up with 1 year too. And that happens when a non-spouse beneficiary tries to use the rollover method to move inherited accounts. Can't do that. Here's another real life case. If you take money from an inherited account, you don't pay the 10% early distribution penalty. And Ms. Sears knew that. She inherited her husband's account, but then she moved it from Merrill Lynch to another financial institution, and she didn't go to the other financial institution and have them do an ACAT. She did a rollover, put to her own account. And when she took the money from that account, she ended up owing the IRS a 10% early distribution penalty. She should have moved it to a beneficiary account because that would have been reported with a code 4 in box 7 of 1099-R, which says to the IRS, she's cool. No 10% penalty, only income taxes. This is where, as they say, a little knowledge is dangerous, right? You think you know, and it sounds like you do, but there's those little exceptions, those little nuances that affects the end result, right? How do you move an inherited account? Always has to be a trustee-to-trustee transfer for non-spouse beneficiaries. If it's coming from a 401k to an IRA, has to be a direct rollover, right? Otherwise, you can't do it unless you're the spouse beneficiary. And even if you're the spouse beneficiary, if you move it the wrong way, you could end up owing the 10% early distribution penalty if you're under age 59 and a half, because you can't do a rollover to an inherited account, right? Sounds like we need a huge book, a checklist to make sure that we get all this right. So many things to keep track of. Now, this person, Miss Jankovitz, she inherited 2 IRAs from her aunt, 2 different financial institutions. And she had a conversation with her husband, and they agreed that she didn't need the money. So she was just going to transfer it to a beneficiary account. She went to financial institution A, told them the story. They were very pleasant, gave her a check. She ended up with a rollover because they did a distribution. Wrong terminology, right? That's what I was talking about. You got to use the right terminology. She told them she wanted a rollover, and they gave her a rollover. She couldn't do it. Then she went down the street to bank number 2. It was like copy-paste. Same thing. Because the banks don't care, I'm sorry to say. Doesn't matter how nice they are. If you tell them what you want, they care about getting the transaction processed. They don't care about the tax implications, because when you sign that form and say you want it, right above your signature somewhere there, it says you have consulted with your tax advisor and they're not responsible, right? Some of them call themselves passive custodian, meaning we don't care, right? So sometimes you just want to get the transaction done, but the question becomes, is it going to be right in the end? And how do you make sure that it's right? Any questions? I love the, yes, sir.
So the thing you do is, if I caught this right, is you want to transfer an inherited account to a beneficiary something, not transferring all that money to your own existing IRA.
That's right. That's right. Everybody heard that? No. So you inherit an IRA, right? And you're not the surviving spouse of the decedent. You're a non-spouse beneficiary. And the IRA owner had the account at firm A. You don't like firm A. You want to move it to your financial institution, right? How do you do that? You have to go to the financial institution. Say you want to move it to Joe. You go to Joe and you say, Joe, I inherited an IRA from my aunt and I want to move it to you. You have to go to Joe. You can't go to the other financial institution that has the account and tell them, because they're going to give you a check. And that's going to be a distribution. And then we have a problem. So you'd go to someone like Joe, and Joe would say, okay, I'm going to do a transfer, not a rollover. Set up your beneficiary account and request the assets. Right? Because a non-spouse beneficiary cannot do a rollover. Yes, sir?
What about spouse?
Now, for a spouse, part of Joe's process, Joe, I'm going to tell out one of your secrets, okay? Part of Joe's process is, if you're a spouse beneficiary, you have three options. You can keep it in a beneficiary account. You can roll it over to your own IRA. You can treat it as your own, as if the decedent didn't own it. But part of what you got to do is say, okay, this is a spouse beneficiary and they have multiple options. Which one should I choose? If the beneficiary doesn't know what to do, or if the financial advisor doesn't know what to do, the best solution is for the spouse beneficiary to keep it in an inherited account until they know what to do. And the reason for that is, if it's in a beneficiary account, you can move it to your own account later on, but if you put it in your own account, you can't go back. You want to keep it in a beneficiary account if the spouse is under age 59 and a half, because then it's going to be reported as a death distribution, which is exempt from the 10% early distribution penalty, right? And then after they reach age 59 and a half, you still have to ask the question, should they put it in their own account at that point? Because the spouse might have inherited the boat and the vacation property and everything else, and might say, you know what, I don't need this money now. And if the person that died was younger than the spouse and died before they reached that RMD age, then you still want to keep it in a beneficiary account, because they don't have to start taking RMDs until the decedent would have reached their RMD age. And once they reach their RMD age, then Joe's process is to switch it to their own account at that point, because then the distribution requirements would be lower. A lot of moving parts, right? Which is why you got to work with someone who doesn't just know what an IRA is, but knows the inner workings of the IRAs and can answer that question. It's a spouse beneficiary. They have three options. Which one should I choose? Right? Because there are three right answers, but what's going to be the tax consequences? What's going to be the end result? Is there going to be a 10% penalty that we need to think about? Is this a situation where we want to minimize distributions as much as we can? Right? I love these questions. Here's another one. If you inherit a 401k and you're the surviving spouse, and the owner died before they were supposed to start taking RMDs. You heard me talk about the new 10-year rule, right? But as a spouse beneficiary, you can choose the 10-year rule, you can take it over your life expectancy. You know, a lot of the 401k plans are saying, we won't want to bother with the life expectancy. It's too expensive to administer that. We're going to saddle you with the 10-year rule. So now you're talking to Joe. Now you're talking to Joe, and you're saying, Joe, they told me that I have to take this $20 million account over 10 years. And Joe says, not under my watch. Right, Joe? And Joe says, you know what? I'm so glad you came to me before December 31st of the year following the year in which a participant died, because we can just kick that in the rear and roll it over to a beneficiary IRA and allow you to take it over your life expectancy. Because every time they put up a roadblock, right? Every time they put up a roadblock, there usually is a solution. You just got to know what to do it by the deadline, right? And that's what happened to the spouse beneficiary. When she called us, it was 2022, and she had a check for quite a tidy sum. And they had sent her a check and said, our condolences, your husband died, and he left you this huge sum of money. Here's your check, and you can't roll it over. And so they're upset because they're saying, she's a spouse beneficiary. Can't spouse beneficiaries roll it over? Guess why she couldn't? Because that plan said she had 5 years to take it out. And because she didn't take action by December 31st of the year following the year of death, and it was past the 5-year period, she had to include the amount in income. Pretty sad. So if you inherit money and you don't know what to do, just take all the statements and dump it on Joe's desk. He has a crack team over there. They're very good, man. Because sometimes I had conversations with these guys. I can't believe they're so young. You know, they're pretty savvy. The questions they're asking me, I'm like, are you sure, you know, you're not 50 and has been in the business for like 30 years? It's true, it's true. You know, because they know that when a client comes in and gives them an article that says the Wall Street Journal says this and it might be accurate, they know that sometimes you have to ask additional questions because that client's profile might require something different. And I really like that about you guys, right? Go above and beyond for your clients. Thank you, because, you know, more people are protected, less mistakes are made. So, what's the takeaway here? Listen, I have a lot of clients that ask me to come in and do presentations like this. I don't always say yes, right? I know who I work with, and part of what I do when I do these presentations is I say what my client does. And if it's someone who, you know, feel like they know enough that they don't need to call me and they make a lot of mistakes, I will not do a presentation like this for them because I'm a lot of things, but I'm not a liar. And I'm not going to come to their event and say they do stuff that I know that I'm begging them to do and they're not doing. For Joe, I will stake my reputation on Joe because everything that Joe does is to make sure that his clients have good results. And Joe understands. I don't know anything about the market. I don't. You know, I don't manage my own money. I don't do my own taxes. I know what my weaknesses are. But this is where I know stuff, because I love it. You know, they used to laugh at me when I used to work at Pershing. Can't you come out on Friday night and hang with us? You're always reading those big books. But what they don't understand is that I love this stuff. I really do. And that expression that says, find a job that you like and you never work a day. If I was rich, if it was me that won that lottery, 1 point something billion, I would still do this because I love it, right? And I appreciate working with someone like Joe because he knows that I do, and he likes it a little bit, but he has a whole lot of other stuff. He does the market, he does the this, he does the that. And so Joe partners with people who can help his clients, right? Everybody does that, right? You go to your CPA and they say, oh, I don't need anyone, I can do all this. Then you start to be a little bit suspicious, right? You know, you guys have worked in companies and you know that there's division of labor and all that. And when it comes to your IRAs, that's very important. It's very important I talk about tax attorney. He was a tax attorney, brilliant man. He should have known that he needed to talk with an IRA expert to make sure that he got it right. And they don't tell him that you look at the IRS publications at your own peril. Crazy, man. He's nuts. But so part of what Joe does is he looks at opportunities to prevent loss or gain of a 10% penalty. It's pretty significant, right? 10%, if someone's taking money from their retirement account early, it's because they need it. And they shouldn't be in a position where they have to pay the 10% penalty if they could have qualified for an exception. Joe loves to review paperwork. Sounds boring, right? But, you know, one of the things I can guarantee you is that, you know, imagine in your mind the angry client pointing to the advisor saying, you mess up my account. That advisor won't be Joe, right? Because Joe will do things like review your paperwork and make sure that the options that you check are right and your goals and objectives are met when it comes to moving your retirement assets. And be extra careful with beneficiary distributions, because Joe, we know that a retirement account owner can take a distribution from a 401k, roll it over within 60 days, but a non-spouse beneficiary can't, right? And so that's included in Joe's verification process to identify who's the client. Is it the owner? Is it the beneficiary? Because the rules are different based on who is the client. So we know now that the rules are complex. I know you guys knew that already, right? This is not something that we should toy with. Do we all agree? Yes. Yeah. And doing it yourself, listen, man, Joe told me how smart you are. But if you're not IRA smart, you know, any engineers in here? Any engineers? No? Don't make me say something and then you say, you know, I'm an engineer. So my experience with engineers is, right, they think they know everything.
Yes. I used to work with engineers.
You know what I mean, right? So don't be like them. Ask for help. Ask the right people. I don't care how smart you are. You know engineering, you don't know IRAs, and don't think that you can take up the tax code and figure it out overnight, because then, you know, that's where mistakes come in. I believe in interviewing whoever I'm talking to, right? If it's your advisor, ask them. Make a list of 10 questions. Use the handouts that Fairhaven gave you, and come up with your own questions. What would you have done in this case? Is there something special that you would have done, right? I know Joe would pass with flying colors, calling me on a Saturday. I'm kidding. Joe knows I love it. That's why he calls me on a Saturday. And before you do anything, call Fairhaven, right? Because they will help you make sure that you don't make mistakes. I don't see anyone sleeping. Thank you. I appreciate you. Thank you. Any more questions? Yes.
I have a question on page 15 about who's subject to RMDs by account types. And I didn't understand what the designated Roth IRA up to 2023 is.
Oh, great question. So remember I was talking about how Roth IRAs are not subject to RMDs? Right. Oh, thank you so much. So on page 15, it says which accounts are subject to RMDs, and it says designated Roth accounts up to 2023. Yeah. Oh, good. She says, what's a designated Roth account? You've heard about Roth 401ks, right? And Roth 403bs and governmental Roth 457bs. Collectively, they are referred to as designated Roth accounts. Yeah. So, but most people, you only heard about Roth 401ks, right? Everybody calls them Roth 401ks.
I've only heard of Roth IRAs.
Oh, really? She said she's only heard of Roth IRAs. So if you work for a company that has a 401k or a 403b or a 457b, they could have a Roth feature, and that's referred to as a designated Roth account. Yeah, so if it's a...
Roth IRAs aren't designated.
No, Roth IRAs are just Roth IRAs. Roth 401ks would be a type of designated Roth account. Yeah, good question. People engaging. Yes, sir.
I'm reading, I don't know if it's true or not. You can't tell what's true on the internet anyway, but they're gonna change their currency. Is that true?
They're going to change the currency. Anybody knows? See, this is where I was talking about earlier that I know IRAs, but I don't know currency. Anybody knows if we're changing currency? Oh, someone over here says they're trying to push crypto.
So that means our money, what money we have is not gonna be any good?
Don't worry about it. It's not gonna happen.
Oh, someone over here, he looks knowledgeable, says it's not going to happen.
He's an engineer.
Just play one on TV.
Yeah, thank you for that. Any more questions? Yes, sir.
You hear so much about dealing with Fidelity or dealing with Schwab, and as I listen to you, it just seems to me that if we are dealing with Fidelity or Schwab, if you don't have an intermediary like an RIA advisor to help you out, you have a very high likelihood you're going to go down the wrong road because they only have one objective, and that's to take your money and get off the phone as quickly as they can.
Exactly. Everybody heard that? Yeah. So he's saying, his example is a Fidelity or a Schwab. If you're working with them, it's all about volume. How many calls did I take today? But they're not going to go the extra mile to help you make sure your transaction is right. So you need to work with an advisor who's going to act as an intermediary and make sure. You know, that $1 million account that I talked about, that was actually from Fidelity. Yeah. They just gave him the check and say, have a nice day. And it's not that what they did was wrong. It's that they didn't go the extra mile. And once upon a time, they used to. But they're not doing that anymore. And so he took it to another financial institution and ended up with a taxable transaction. So yeah, you got to work with a financial advisor who's going to say, pump the brakes, right? Let's see if this is right. Because we're not about volume here. We're about quality. Because we want you to tell your family how great we are and tell your friends how great we are, right? And so we got to make sure that you get quality service. What do you want to have accomplished? And we make sure you get that done.
So you could go with a Schwab or a Fidelity or a Vanguard and get on one of these programs where they talk about how low their fees are. You think you're ahead of the game, when in reality, if you went to an intermediary like a financial advisor, you're going to pay a little bit more, but look what you're getting for that difference
Yeah.
in terms of the safety and good counsel and advice.
Exactly. So he's saying, we have an expression in Jamaica. It says cheapness always work out to dearness. And dearness is Jamaican for expensive, right? So he's saying, you know, you think you go directly to the financial institution and the trading fees are low and you think you're saving some money. But then you end up with mistakes like the ones that we talk about because they're not going that extra mile, right? Any more questions, comments? You guys have been a fantastic audience. Thank you.
Well, thank you for coming out this evening. Take advantage of Denise. She's truly that expert. Try and stump her with a question. And, if you stump her, I'll buy you dinner. Thank you. We're finished, and thanks for coming out. Have a nice evening.
Thank you.